In our previous video, we looked at market demand and market supply. So now let's put them together. So first, market demand is the relationship between price and the amount that consumers are willing and able to buy. So market demand looks at the relationship between price and quantity demanded, and we're looking at multiple consumers. We looked at supply. And when we talk about our market supply, we are talking about the relationship between price and the amount that producers or businesses are willing and able to sell. So again, it has to do with the change in price. And the difference here is that we're looking at it from the business perspective. But if it's market supply, it's multiple businesses. So we're looking at how much collectively they are willing and able to sell. So we want to combine the market demand and market supply. So we need to look at what does it mean to be a market. So a market is a mechanism that brings buyers and sellers together. So anywhere the buyer and the seller come together, negotiate a price or a quantity sold, we have a market. So what are some examples of markets? Where do you go to buy or sell things? Okay, grocery store, gas station, the mall, Kijiji, eBay, farmer's market, garage sale, right? There's lots of places where buyers and sellers come together. So these are markets. When the buyers and sellers come together, it will determine the market price or that equilibrium price. This is the price that buyers buy at and sellers sell at. So we want to look at how do we get to this equilibrium or market price? How do we get to that price that you actually pay when you are at the store? So let's go back to the craft beer example we were looking at in the previous video. So here we have quantity demanded and quantity supplied at different prices. So we want to look at what happens at these different prices. If the price is $18, we notice that the quantity demanded, the amount that consumers are willing and able to buy, is higher, right? Lower price, better deal, maximize our consumer surplus, that difference between the value to us and what we actually have to pay. Now, at those lower prices, though, businesses aren't willing to sell as much. They're not making as much profit per unit because remember, we're holding cost constant and we're just changing the price. So notice here that the amount that consumers are willing and able to buy is 22, but the amount that businesses are willing and able to sell is only 8. So these don't match. Do we have a shortage or a surplus? Well, a shortage is when quantity demanded is more than quantity supplied. We want more than there is. A surplus is when quantity supplied is more than quantity demanded. There's excess on the shelf. Well, the challenge with shortages and surpluses is the economy or this market is not in equilibrium. We want more than there is, or there's too much. So what happens when you have shortages and surpluses is it changes the price. So think about it this way. In this craft beer market, like at $18, if we want 22 cases and businesses are only willing to sell 8, the problem is that there is a shortage of 14. There's a bunch of us who are not getting the craft beer that we want. So what happens? Well, if it is the must-have gift at Christmas time, right, then people buy them, they put them on eBay, Kijiji, and they charge huge amounts of money, right? Well, if you think about it in a store, if we're going to the liquor store to buy beer and A bunch of people want it. There's only one left on the shelf. How do you decide who gets it? Well, if it's you versus Granny, you're probably not beating up Granny in the middle of the liquor store. So what does the liquor store do if there's lots of people who want something and there's only a few available? Shortages cause prices to go up, right? How do we decide who gets it? Well, instead of a fist fight, it's whoever is willing to pay more. So whenever there's a shortage, it drives the price up. Well, what happens if there's a surplus? If there's a surplus, there's too much, more than the customers want. Well, if you're the liquor store and there's all this excess craft beer sitting on the shelf, how do they get rid of it? Well, they put it on sale. So whenever there's a surplus, the price falls. Shortages and surpluses put pressure on the price in the market, pressure for the price to change. Market equilibrium is where there's no incentive to change, when the price stops moving. So we want to figure out where that is, and that's what determines the price that you pay at the market. Because the craft beer, the liquor store, doesn't want to be stuck with extra. And as customers, you don't want to constantly be paying higher and higher and higher prices. So we find that kind of happy medium equilibrium, and that creates that stability. So let's figure out where that is in this example. As the price goes up to $19, the amount that customers are willing and able to buy is less. Law of demand. As the price goes up, there's less that we are able to buy, and perhaps less that we're willing to buy because we'll switch to drinking something else. But at the higher price, businesses are willing and able to sell more. So here we have quantity demanded of 18, quantity supplied of 12. So do we have a shortage or a surplus? We have a shortage of 6. Okay. Now let's go to the other extreme. Let's look at really high prices like $22. At $22, it's gotten too rich for a lot of people to buy that case of craft beer. So the quantity demanded is now 6. But now businesses are willing to get into the craft beer market because they're making large profits. Remember, holding everything else constant except for the price, so ceteris paribus, higher prices, costs stay the same, bigger profits. So quantity supplied here is 24. Are we in equilibrium? No. Quantity supplied is more than quantity demanded. So do we have a shortage or a surplus? We have a surplus. How much of a surplus? We have a surplus of 18. So there's 18 extra cases sitting on the shelf that no one's buying. Well, when there's a surplus, what happens to the price? It goes down. So we move from 22 to 21. All right, so here, quantity demanded is a little bit higher, okay, because it's cheaper. We can afford a bit more. So now quantity demanded is 9. Quantity supplied, not as high, not as big a profit margin. So quantity supplied is 20, quantity demanded is 9. Do we have a shortage or a surplus? Quantity supplied is more than quantity demanded, so we have a surplus. How big is that surplus? 11. Whenever you have a surplus, what happens to price? It goes down. When we were working on those lower prices, we had a shortage. And we know that when there's a shortage and we're all fighting for that last item, the price goes up. So when does the price stop changing? Well, notice that at $20, the quantity demanded, the amount the customers are willing and able to buy, is the same as the amount that businesses are willing and able to sell. So here, because quantity demanded is equal to quantity supplied, we are at equilibrium. And the market price is $20. If the price in the market is lower than that, there'll be shortages that will push the price up. And if the price is higher than that, there will be surplus items on the shelf pushing the price down. So at equilibrium, where quantity demanded equals quantity supplied, there's no incentive for the price to change. We can see that here on this graph. So we can graph that same table of information, and we see that where the demand curve and the supply curve intersect is at that 16 units. So our quantity sold, or equilibrium quantity, is 16. That's where quantity demanded equals quantity supplied, and the price in the market would be 20. If we are not at this equilibrium, then there's pressure for the price to change. So for example, here at a price of 21, we have our quantity supplied of 20 and our quantity demanded. Just going to refer back to our table 4 so we get the exact numbers. At, what was it, price of 21, we're at 9. Okay. So here we have quantity demanded of 9, quantity supplied of 20. There's a surplus of 11, pushing downward pressure on the price because there's too much sitting on the liquor store shelf. Alternatively, here at a price of 18, and I'm just going to pull our exact numbers here, at a price of 18, we can see that the quantity demanded is 22, but the quantity supplied is 8. So quantity demanded is more than quantity supplied. Customers want more than businesses are willing and able to sell. There's a shortage. And here, if customers want 22, but there's only 8 available, then we have a shortage of 14. Well, that means that you're not getting the craft beer that you want. So people are buying it, selling it for more money on an alternative market. There's fights in the liquor store. How do you resolve who gets the liquor that's left? The prices go up until we end up at this equilibrium. So when we look at the price change, we can find what happens to quantity demanded, what happens to quantity supplied, and ultimately we can determine that equilibrium or market price, because that's the price at which quantity demanded is equal to quantity supplied, okay, where the market is stable. Now, what happens though when we start changing other things besides price? So what happens if there is an increase in income? It's a change to the consumer. Okay, it's going to change demand. So notice when we start to change one of those 6 determinants of demand, we no longer have equilibrium at the old price. We now have more quantity demanded than quantity supplied. And we know when quantity demanded is more than quantity supplied, it drives up the price. So when you start to change things other than price, like income, preference, prices of substitutes, and complements, right? What are the other 6 determinants? They will then find a new equilibrium because that change in demand creates, in this case, the increase in demand, creates a shortage and drives up the price to the new equilibrium. We can also have changes in supply. So if a business has new technology that makes them more efficient, they are now able and willing to sell more at the current price. So notice here we were at equilibrium before. Now quantity supplied is more than quantity demanded, so we now have a surplus. And surpluses do what to price? They push downward pressure on the price, and we end up at a new equilibrium. Pick a different color here. At a new equilibrium at a lower price. So we first need to find equilibrium to determine what the market price is. How much quantity will actually be sold? Where is quantity demanded equal to quantity supplied? What's that equilibrium price? Then we can start to look at what's changing demand. How does that then change what that equilibrium price is? Or perhaps we have a change in supply. And that change in supply will then change the equilibrium price. So we're just further complicating our economic model to start to illustrate what's happening in our society. So in a later video and in our class activities, we'll start looking at what happens when you start to change demand and supply. What does it do to the price? So we first find our market equilibrium, figure out what's happening to the business, supply, what's happening to the consumer, demand. And so that's why it's really important to know the 6 things that change demand and the 6 things that change supply, because if you can identify if demand or supply is changing, you can predict what's going to happen to the price in the market.